Hello and welcome to our channel. My name's Charles Dynastic. I'm the Managing Director of Bluebond Tax Planning. We've been helping clients to eliminate their inheritance tax for more than 18 years now. And today's video is what I believe a very important topic for an awful lot of people, especially in and around London, where they have high value main residence. So today's video is: how do you save money for inheritance tax purposes on your main residence? Okay, so if you find this video useful, please give us a like, but we'll get straight into it after the introduction. So how do you save money for inheritance tax purposes on your main residence when, in most cases, people want to continue to live in their main residence and die holding their main residence? So the first thing obviously depends on the value of the property. Is it worth $500,000 and therefore falls well inside your allowances for inheritance tax purposes, or is it worth 3 million on its own and therefore falls well outside? So it'll depend on the planning, depending to a very large degree on the actual value of the property. Okay, so in most cases, property in the UK, in most years anyway, grows faster than the allowance for inheritance tax, because that is tied, even though it's been frozen for a fair number of years, is tied to CPI, Consumer Price Index, which may go up at 1.5% a year, whereas property generally grows up about 3 to 5% in any given year on an ongoing basis. That's just been 20 years of the past history, right? So the growth will always tend to exceed the allowances. Now, the second point is using your residential nil rate band properly. So if you recall, this is an additional allowance which got put in a few years ago, and at this moment it's £175,000 per person, providing you own a property that you live in and you leave that property to direct descendants, which is children, grandchildren or adopted children. So you can't leave it to brothers, sisters, cousins, anybody else. It has to be left to direct descendants, and that's the only way that you can get that particular allowance. So that's the residential nil rate band allowance. Lastly, as I said, it depends upon the value. If you've got a very large value property, then there will be completely different planning that you can do with it. So the first choice, pretty obvious. You can downsize from your home. Most circumstances, this doesn't tend to happen. People get older, they like living in their property. Why should they have to move? All of their friends are living, close by, their relationships that they've built up over years. Sometimes people will downsize because the property gets too big to maintain, but usually, for our clients anyway, the cost of finding somebody to cut the grass and keep the garden maintained and whatnot, and even come in and clean, is fine compared to the whole upheaval of moving house. So downsizing isn't often an option, but if for you it is, then obviously that's a major benefit, because you can go from a house worth a couple of million to one worth 500,000 in a different area potentially, and then you've got the capital which you can then release out of your estate, bearing in mind that generally that would take 7 years. Okay, so how do you get rid of the money once you've downsized? Well, you can make direct gifts to your children, potentially exempt transfers. Remember, that takes 7 years to enact. There are other plans. You can paste money into trusts, which are chargeable lifetime transfers. Make sure you get advice on that. You can buy exempt assets. Again, be careful about the risk on those, because it's investing normally into single companies to get something called business property relief. All of that we'll go into in other videos, because obviously we can't cover everything in one video. But generally there's other plans you can utilize to then get rid of the problem, provided that mainly you live 7 years at least, right? Another solution is staying in the house and utilising equity release. Now, in the past, people have got very nervous about this particular methodology of planning because, sometimes the value of the property with the costs of the plans isn't covered by the value of the property and people have been kicked out. But Save Home Income Plans avoids that, and even if the interest rates are too high and exceeds the value of the property, you can still maintain to be in the property. Again, for most people, they're a little bit nervous about this planning, but for some people, it makes sense because you can release the money. And if you were to do it for our clients, we would normally talk about doing it from depending on their health, obviously, from age 75 onwards. So you leave it as late as possible because the interest rate on the plan, you don't want it to have too long to accumulate, but you need 7 years for it to be outside of the estate. So 75 seems a reasonable age of which to consider equity release, depending again on the value of the property. Now, you can do a different type of equity release, which just gives you an ongoing income stream. And of course, you could spend the money and that would reduce your inheritance tax liability. Of course, because you don't know when you're going to die and how long you've got, that can be a little bit more of a fraught issue. So most of the time, people release a lump sum of capital, gift the money away, even gifting the money away on a gradual basis into trust and then whatever we've mentioned previously. What you do have to be careful of is buying exempt assets if you take a lump sum equity release. Okay, so this is one of the details that catches people out. I always talk to people about the devil being in the detail when you deal with inheritance tax, but it's a very small unknown rule where basically if you borrow money and then invest in assets which is exempt from inheritance tax, the exemption won't work, and therefore HMRC will disallow it. So don't buy exempt assets. You can give it away, absolutely. You can give the money away to your children or give it away into trust. That's different. It's not buying assets which are then exempt from inheritance tax. Again, be careful on the details of any equity release plan. Sometimes people get tied into all sorts of things and they haven't read the small print properly. Always take advice. Really, these things are too fraught and it's not something you would have experience of. You're only likely to ever do it once. So make sure you get good advice on equity release. And everybody who does it needs to be qualified anyway. Lifetime trusts. So this is a mechanism by which you can use trust planning with your wills, and when you die, part of your property, 325,000, goes into a lifetime trust that you pre-set up. Now then, what the planning works on is that the husband, say, dies first, 325 goes into the house, the remainder of the house sits in his wife's estate, right, if she's the second to die. Now, there's two savings there. One, where the value of the house is likely to increase the allowance for inheritance tax, because as I said, that grows at CPI. So 325 growing at 1% a year, whereas the 325 in the trust is likely to grow faster at 3 to 5% a year. So therefore the gap between the two gives you a saving. But there's another additional major saving, is that the amount of money that's left in the remaining surviving spouse's estate is then reduced by 10 or 15% on the value of the house. Why? It's another tiny little anomaly within IHT planning, but basically it means that because two people, the trust, I say two people, two separate legal entities, the trust on the one hand owns part of the property and the surviving spouse owns part of the property. And because of that, it reduces the value for inheritance tax purposes. But if you've got £1 million plus property, that's not an inconsiderable saving. So again, well worth looking at and well worth setting up. So lifetime trust, 10 to 15% saving. Gifting part of the property away. Not a lover. Not a lover of it because it's too fraught with too many issues. You give part of it away, you can't give away part or all of your property and continue to live in it without paying market rent. Market rent is what you would expect another person who owned that property to expect in rent, and you would get some quotes from agents and whatnot as to what you would expect. So you would have to pay market rent if you gave away the whole property. As what most people do is they try and give away part of the property, and even if they're sensible enough to pay the market rent and they can afford it from their income, there are other issues, right? Because there's what's the rent subject to, first of all. So if the rent is then being paid to your children who now own part of the property, they're going to have to pay income tax on that income. And if they're higher rate taxpayers, that's a 40% rate. Say you've given away 50% of the property and then you live 10 years, well, the 50% is then going to be liable to capital gains tax. So when you add up the income tax that the children have to pay plus the capital gains tax, are you making much of a saving? Don't know. The calculations have to be done. I'm not saying it's not completely worthwhile, but generally it's fraught with all sorts of issues, really. Okay, so lastly, it's the tax, and it's looking at all the taxes and looking at all the taxes together to determine it. And as I say, I'm not a lover, because generally speaking, there's too many things that can go wrong with it. Okay, so that's giving away part of the property. So those are generally your issues. Downsizing, obviously, and giving the money away, obviously the best. Equity release, you've got to be careful on the details, on the interests. Don't buy exempt assets. Gift the money away once you've got the equity release, or spend it. The lifetime trust issue is definitely a good one, and that definitely saves some time. And don't generally give assets away. If you give your house away completely and then go and live in something completely different, fine, right? But if you're still living in it, be careful that it's a gift with reservation. So that's what you need to do with your main residence. I hope you found that video useful. If you did, please give us a like below. You'll find also below links to our free ebook around inheritance tax, and also a much more detailed and fully comprehensive guide to inheritance tax. But thank you very much for listening, and goodbye for now. Thank you.